Welcome to the Project Management Prepcast, helping you to prepare to take the PMP exam with your host, Cornelius Fichtner.
Hello and welcome to the Project Management Prepcast. I am your instructor, Cornelius Fichtner. In this episode, we will discuss a number of advanced theories and concepts from project cost management that are not necessarily discussed in the PMBOK guide. The good news is that you don't really have to be able to calculate any of the formulas behind these concepts. Instead, you have to understand the concepts themselves and make appropriate decisions on your projects based on this understanding. Here are the learning goals. At the end of this episode, you will be able to describe sunk cost, explain opportunity cost, define the benefit-cost ratio, explain the difference between present value and net present value, describe the payback period, and give two forms of showing negative numbers. We begin with sunk cost. Sunk cost is all the money that you have spent in the past. As an example, let's take my mountain bike. I bought it many years ago for around $1,100. Since then, I have needed to take it to the shop several times to get it fixed. And I guess that I have spent about $500 at least so far on getting this bike fixed up again and again. Now, I once again have gotten a flat tire. Actually, it's both the front and the back wheels that have a flat tire. And because I'm not so good mechanically, I have to invest more money into repairing this bike. That's going to cost me at least another $80, but then I have another working bike again. I'm really not worried about all the money that I have spent in the past on this bicycle. In order to make a decision, should I or should I not have the bike fixed, I'm looking at the current needs and my future benefits. And it is the same thing with the sunk cost on our projects. Don't look back, look forward, and that is much more difficult to do than it sounds. Just think about it. If you have already spent $500,000 and you need to invest another $200,000, but you also know that you will only get back a profit of about $400,000, well, should you still move forward? The sunk cost is gone. So evaluate with a forward-looking attitude. To an accountant, this is a normal thing to do, but to us project managers, it's really easier said than done. Next, we have the opportunity cost. The opportunity cost looks at what you could have done, but you didn't. So it's indicating the missed opportunity. Here is an example. You could have bought that old chair at the flea market last Sunday for only $5, and it might have turned out to be a Chippendale worth $10,000. So your opportunity cost, the opportunity that you have lost in this way, would be $10,000. Now, don't make the mistake and subtract the $5 that you would have paid for the chair. No. The opportunity cost is always 100% of the opportunity that you did not select. So your lost opportunity here is $10,000 and not $10,000 minus the $5 that you would have paid for the chair. Another similarly easy concept to understand is the value analysis. And the idea behind the value analysis is to take a look at all the requirements and features or functions of your project's final product and then assigning a value to each of these. In your next step, you are now going to try and decrease the cost of these requirements, features, and functions, the cost of production, that is, of course, but without reducing your scope. So you keep all those features and functions, but you try to produce them less expensively. You attempt, in other words, to create a cost reduction without a scope reduction. And that's really what value analysis is all about. Calculating the internal rate of return, the IRR, is a rather complex thing to do, and the good news is you don't have to be able to do this on the PMP exam, and that immediately makes the internal rate of return a rather easy concept to understand for the PMP exam. So in order to explain this, let me begin by asking you an investment question. Let's assume that you have some money and you can invest this money either in bonds from company A that have a yield of 7%, or you can invest this money into company B where you will get a yield of 5%. Now, assuming that the risk and everything else is the same and you only have these two numbers, which one would you choose? Of course, you would go with the one that gives you the higher yield. You would take company A because they're paying out a 7% interest. And it's exactly the same with the internal rate of return. So let's therefore ask a project question. You can choose between two projects. Both projects will cost you 1 million yen. Project A will bring you an internal rate of return of 50%, and Project B will bring you an internal rate of return of 10%. And of course, the other factors of these two projects are identical. Which one of the two would you choose? In this case, of course, once again, you would choose Project A because it has a much higher internal rate of return. And this is the simple rule to remember. The bigger number is the better number when we talk about the internal rate of return. Let's look a little bit more in detail at the internal rate of return, and let's begin with the definition. Here it is. The internal rate of return, the IRR, is a capital budgeting method used by firms to decide whether they should make long-term investments. Let me give you a little bit more background here in technical terms. The IRR is the rate, the return rate, which can be earned on the invested capital. That is to say, the yield that you get on the investment. Therefore, a project is a good investment proposition if the IRR is greater than the rate of interest that could be earned by alternative investments. That'll help you make that decision. For instance, if my internal rate of return is 7%, but I could invest this money into, say, buying bonds from the bank where I get 9%, okay, probably a fictional number, but still, I get the higher return if I just put the money to work when I give it to the bank. So, of course, the higher rate there is the better rate. And don't worry, like I said, about the formulas for this, because you do not need to know the formulas for the exam. Just remember that the bigger IRR is the better IRR. So this means that if you have two projects, you would select the one with the bigger IRR. And this rule to select the project with the bigger number is also valid for our next term here, the benefit cost ratio, the BCR. As the name implies, the BCR calculates a ratio between the benefit and the cost of a project. And the bigger the difference between the benefit and the cost is, the bigger the ratio will get. For instance, a ratio of 5.1 indicates that this project is preferable over a project that only has a ratio of 3.5. But now let's turn this around and say, all right, I have a BCR of 5.1. What does that mean? Well, It means that your benefits are 5 times greater than your cost. And instead of benefit, you could also say payback. So the payback is 5.1 times greater than your cost. And this takes us straight to the next topic, the payback period. You have probably heard this term before. The payback period is simply the time it takes until you make a profit. If you spend 500,000 yen on a small project and you will have a revenue of 100,000 yen every month, well then, 500,000 by 100,000, your payback period is simply 5 months. To put it into technical terms, the payback period in business and economics refers to the period of time required for the return on an investment to repay the sum of the original investment. Let's take another example, for instance. A $1,000 investment, which returns $500 per year, would have a 2-year payback period. It is intuitively the measure that describes how long something takes to just pay for itself. Shorter payback periods are obviously preferable to longer payback periods. As long, of course, as everything else, the risk and all the other factors, are equal. So, for the exam, you need to remember that if you are comparing the two payback periods of equal projects, then a payback period of 6 months is better than a payback period of 12 months. Because you will be making a profit after just 6 months after the project is over. Next, we have to talk about present value. I have 10,000 US dollars right here. Okay, they're not real US dollars. I took them out of my Monopoly game, but for the purpose of this example here, I have 10,000 US dollars right here. I can give these $10,000 to you right now, or I can give them to you in 3 years. What would you prefer? Right now, of course. Why? Because the value of having that money right now is much greater than if I gave it to you in 3 years. Instead of waiting, you would have it right now and you could do something with this money right now. But then let's look at this from my point of view. If I give you the $10,000 in 3 years, I can go ahead and I could put that money to work for me. I could, for instance, put it into my bank account that pays me around 3% of interest. So in 3 years, these $10,000 would be bigger than today. So if my plan is to give you these $10,000 in 3 years, and then you come to me and you say, can I please have this money right now? I'm going to say, sure you can, but not the whole $10,000. I will calculate the present value, which by the way is $9,151, and if you put that into a bank account at 3%, then in 3 years you will have the $10,000. And that's the idea behind present value. If you want your money today, instead of in 3 years, I'm going to give to you what the money is worth today. This may be one of those areas that you may have to calculate on some PMP sample exam questions. So let's take a look at how this is done. Let's begin with a quick overview here again. PV is the present value, which means that receiving the money today instead of getting the money in 3 years has a different value, because in the meantime you could invest that money. And the formula that I'm going to show you calculates how much this would be today, or rather how much less it would be worth today than it is worth in 3 years down the road. It is also described as value today of future cash flows. Here is the formula. The formula is you take in order to calculate the present value, you take the future value and you divide this by the compound interest, is really what the item at the end is showing us here. So what does this mean in regards to the abbreviations? You take your present value, and then that equals your future value divided by 1 plus the rate of interest to the power of the time that it is invested in years. Let's take a look at an example of how this would indeed be calculated. Here you go. So we have future value of 1 million. The interest rate is 12%. The N, which is the time that it would be invested in, is 3 years. So that means that our present value is 1 divided, well, that would be the 1 million, of course, 1 divided by 1 plus the 12% interest to the power of the 3 years would be this 0.00045 million. So that will be the present value, because if we invest that kind of money into a bank account, or, well, bank accounts don't pay 12%, that would be more something like a investment in shares probably that may pay up to 12%, then we would only have to invest this little money, and in 3 years we would have 1 million as a result. The result, of course, is the money that you need to invest today, the present value, for these n years, these 3 years, at a R% of interest, 12% of interest, in order to end up with your target sum, which is the future value. And this then takes us to the net present value, the NPV. Very much, of course, related to the present value. The net present value is a standard method for financial evaluation of long-term projects. It is used for capital budgeting and widely throughout economics. It measures the excess or shortfall of cash flows in present value terms once you take out all the financing charges that you may have on a particular project. The formula for the net present value is that you subtract the present value of the cash outflows from the present value of all your cash inflows. But the good news is you don't have to really remember this, because you won't actually have to do any net present value calculations on the exam. But what you need to know is this: if the net present value is greater than 0, then the investment is profitable and the project should be accepted. If the net present value is less than 0, this means that the investment is a loss and the project should be rejected. And if the net present value equals 0, then the investment amount is neutral, and you will need to look to other indicators to see if you should do the project or not. And of course, if you compare the net present value of two projects against each other, then the project with the greater net present value is the better project. To finish it off, I would like to be a little bit negative. In particular, I would like to discuss negative numbers. Yes, numbers that are below 0, because on the exam, as well as in sample questions, you may come across two types of formats in which negative numbers are shown. The first one is that it is simply a minus followed by the number. In our example here on the screen, it is minus 123. But it's also possible to show the same number just by putting two brackets around it. So, opening bracket, 1, 2, 3, closing bracket. And this last version here is a standard that comes from the accounting practices in the USA. So that means if you see a number with brackets around it, it means it is a negative number. It is minus 123. Instead of doing a review of what we have just seen in this episode, let's instead review a few of the project cost management concepts that you have to be familiar with and recall them for you so that for the exam you know all of them. So for the purpose of project cost management, you should be familiar with these terms here, their associated concepts and formulas in order to be prepared for the exam. In regards to cost estimating, for instance, you should know the difference between analogous estimating, bottom-up, parametric estimating, as well as computerized estimating tools, which is nothing but project management software, really. And you must be familiar with the earned value techniques and every single formula. You just have to know them forwards and backwards and be able to apply them in scenario-based questions and calculate the correct number. You should also be familiar with the terms of variable cost, fixed cost, direct cost, and indirect cost. You must be able to explain what project life cycle costing means. And, of course, you should understand the basics of present value, net present value, internal rate of return, the payback period, the benefit cost ratio, the value analyses, as well as the opportunity cost. And remember that with the present value, the internal rate of return, and the benefit cost ratio, the bigger number is the better number. And of course, for the payback period, the shorter payback period is the better payback period. And this concludes our look at additional advanced project cost management theories and concepts. Until next time.